In the share market, there are primarily two methods of deciding which share you want to buy and then of timing your transactions. And those two methods are known as fundamental analysis and technical analysis. Now, fundamental analysis is really trying to answer the question, how good will this company be in the future as a generator of dividends? So the fundamental analyst will look at the company's balance sheet, its income statement, he'll interview management, he'll study the industry, all in an effort to try and find out how much the profits of this company will be in the years to come. And then obviously, out of those profits, what dividends they are likely to pay. Technical analysis takes a completely different approach. The technical analyst will study the charts of the company's share price and the volume traded each day. And from those charts, he will try to find patterns that will help him to predict which way the share is going to go in the future. And those, of course, will help him to buy and sell at the right times. Now, in this webinar, we're going to look at the relationship between fundamental and technical analysis, because that is a very, very important issue. To get to the grips with that, we need to ask ourselves the question, what do you get when you buy a share? You get a part ownership of a company listed on the Johannesburg Stock Exchange. But what financial benefit does that bring to you? Well, investors are looking really for two things, for capital gains and for dividends. And what I need to explain to you, what I need to convince you of, is that in fact a capital gain is just a dividend in a different form. To get a good understanding of that, let us take a look at the chart of Sasol over the last 5 years. As you can see, Sasol has gone up and down over this period, and billions of rands worth of shares have changed hands. A single Sasol share could have been bought and sold more than 50 times by members of the public during that period. Some of them would have made capital gains, while others would have made capital losses as the share's price went up and down. But, and this is the important point, the only new money which could have come into that group during that 5-year period would have been the dividends. Unless Sasol goes into liquidation, which is very unlikely, the only benefit that shareholders are ever going to get from holding its shares is the dividends. The reason that share prices go up and down is that investors' perceptions of the future flow of dividends that will be paid by that company changes all the time. If you can sell a share for more than you paid for it, then it is because the person who buys it from you has a higher perception of the future flow of dividends to accrue to that company than you did when you bought it. In other words, a capital gain really represents just a change in the perception of the future flow of dividends. This is an extremely important point, so I would like to illustrate it further with an example. Let us suppose that you found a company that you really like, and you've studied the balance sheet and the income statement of this company, and you've perhaps even visited the company and spoken to one of the directors. You like this company, and so you analyze it carefully, and you decide that in a year's time, next year, it's going to pay out a dividend of 100 cents. This is your forecast. And you look 2 years ahead and you say, well, you think it's going to pay 120 cents in 2 years' time. And then 140 cents in 3 years' time, 165 cents in 4 years' time, and finally 180 cents in 5 years' time. So you've done a 5-year forecast of the dividends of this company based on your analysis. But of course, you would not be prepared to pay 100 cents now in order to get 100 cents next year. I mean, that does not make sense, does it? Because of the inflation rate and the opportunity cost of your money and so on. But you might well be prepared to pay, say, 70 cents now in order to get 100 cents next year. But what about the dividend that you're going to get in 2 years' time? That's 120 cents according to your estimate. But of course it's 2 years away, so you'd probably only be prepared to pay, say, 55 cents now for that dividend. And in 3 years, well, perhaps only 35 cents for that one. And maybe only 20 cents for the 180 cent dividend that you expect to get in the 5th year. And let's say that everything that you expect to get in future years after that 5th year, you're prepared to pay, say, another 80 cents for. So what we have got is a forecast of the future dividends and your discounted cash flow of those future dividends. because the process of reducing that 100-cent dividend to the 70 cents that you're prepared to pay for it now is called discounting. And discounting is perhaps the most important word in the share market. You will often hear an analyst or a stockbroker or somebody saying that such and such an event which impacts on the profits of a particular company has or has not been discounted into that company's share price, has been fully discounted, has been partly discounted, whatever. What they mean is that investors, seeing this event which is going to impact on the profits of that company, have changed the price they're prepared to pay for that share. And so the share price has come down in response or gone up in response. This is an extremely important concept, and we need to take it a little further. Maybe you're listening to this, you're saying to yourself, I'll never have time to make predictions of the dividends of companies on the JSE. And in reality, you are correct. The only people who often do this are stockbrokers, perhaps in their research departments, and big institutional fund managers. They are the guys who do this kind of prediction and discounted cash flow. But actually, you are doing this subconsciously without even being aware of it. Let's suppose that you are interested in a particular share, let's say a gold mining share, and it's trading in the market for 10 Rand. And then suddenly, the gold price falls $40 an ounce overnight. Are you still prepared to pay 10 Rand for that share? I doubt it. Because subconsciously you realize that with the gold price being lower, the company's profits are going to be lower, and that means its dividends are going to be lower. And you have automatically, and without even thinking about it, adjusted your future flow of dividends that you forecast and reduced the amount you're prepared to pay for that share now, today. So you see, that is how you are doing this all the time, and so is every other investor, which means that the share prices go up and down in response to investors' perceptions of the impact of future events on the profitability and hence on the dividends of the companies that they are interested in. Now let us return to our example. If we add up all the discounted amounts that you are prepared to pay for the dividends of this particular share, your forecast of the future dividends of this company, we will come back to what you think this share is worth in the market today. So let's do that. Let's add them up. So we have 70 cents plus 55 cents plus 40 cents plus 35 cents plus 20 cents plus the 80 cents which you are prepared to pay for all the dividends you think will come after the 5th year. So that comes to a total of 300 cents. So if the share was trading in the market for 350 cents, you would regard it as expensive. But if it was trading for 250 cents, you would regard it as cheap, a bargain perhaps, you might even buy it. But of course what you must remember is that this is just your forecast of the future dividends of this company. The next investor we talk to might say, I don't expect it to pay a 100-cent dividend next year. I'm expecting it to pay 90 cents, or 110 cents, or 95, or 105, or whatever. In fact, every investor will have a different perception of what he thinks the future flow of dividends will look like. And the market price of the share is the average of all those investors' discounted cash flows of the future dividends of that company. So the market price could be higher at 400 cents or lower at 300 cents or anywhere in between, depending on whether there were more pessimists than optimists or vice versa. So let me say it again. The market price is the average of all investors' discounted cash flows of the future dividends of this company. Now let us suppose for a moment that you've got a time machine and you can go forward into the future. And you discover that amazingly, your forecast of the future dividends of this particular company is 100% correct. Then you return into today's time, and you see all these other poor investors desperately trying to predict what the future dividends of the company will be. But you now know the truth. You know the real value of the share. Now with that idea in your head, fundamental analysis is the search for the company's real value. That's what it is. Technical analysis is the study of investors' perceptions of the real value of the company as they are reflected in the share's price and volume pattern. In other words, there are two kinds of investors out there. There are conservative people like fund managers, stockbrokers, who do not want to buy a share unless they can see the real value. And then there are others who say the real value doesn't matter. What matters is what people think the real value is. That's what matters. So there is the search for the reality and the study of the perception of that reality, fundamental and technical analysis. Now this has been a very important webinar because it has examined the relationship between fundamental and technical analysis. And of course they are connected, because changes in the fundamental reality impact on the technicals all the time. And it's very important though for you to understand this relationship, because on the framework which I have just sketched out, you can hang everything that you are about to learn about the stock market. I would suggest that you go through this webinar again, and that in fact you read the lecture which is connected with this webinar several times to get a good understanding of what I am talking about.